Hi there. If you're thinking about retiring in your 40s, 50s, or early 60s, there's one expense that can make or break the whole plan. And it's not groceries, it's not property taxes, it's health insurance. For a lot of people, healthcare is the single biggest reason they don't retire early because you can budget for travel, you can cut spending, you can downsize. But it's hard to retire early if your health insurance suddenly becomes like a mortgage payment. And that's exactly what a lot of people are seeing right now. The Enhanced Affordable Care Act, or ACA subsidies, expired at the end of 2025, and many households are getting hit with premium shock. So today, I'm going to keep this practical and no nonsense. I'm going to do three things. First, I'm going to quickly explain why the ACA is still the most common path for early retirees, even with the higher premiums now. And second, I'm going to explain the one thing the ACA cares about most, and it's not your net worth. And third, I'm going to give you a simple framework, 10 ways to pay less for ACA coverage by controlling the income number that drives if you get a subsidy or not and how much. And I'm focusing on the ACA because it's popular with early retirees for a simple reason. It's real insurance. ACA compliant plans can't deny you for pre-existing conditions, and they can't charge you more because of your health history. And marketplace plans cover the essential health benefits, the baseline set of things you actually expect health insurance to cover. So for many people, the ACA is the most realistic bridge to Medicare at 65. Yes, there are other options. The spouse's employer plan can be great if you have it. COBRA can be a useful short-term bridge, but it's often more expensive than the ACA because you're typically paying the full premium, your portion, and what your employer also used to pay, plus a small administration fee. Some people do part-time work specifically for benefits, and some people look at health sharing ministries, but those are not the same thing as insurance, and there's no guarantee they'll pay like an insurance plan would. And you'll also see short-term or other non-ACA compliant plans advertised online that can look cheaper, unless you look closely at the coverage details and protections. So yes, options exist outside of the ACA, and last year I made a comprehensive video comparing those options, the pros and cons of each, and I'll link it in the description and on the end screen. But for this video, I want to stay focused on the ACA and the MAGI levers because for most early retirees, it's the most realistic bridge to Medicare for the reasons we just covered. All right, now here's the key concept you have to understand. The ACA is income-based, not asset-based. Let me say it again because this is the whole game. You can have a big portfolio. You can own your home. So you can have a lot of assets and still qualify for ACA help because the ACA does not look at your net worth. It looks at your household MAGI, or modified adjusted gross income. And the savings we're talking about, premium tax credits, generally only apply if you enroll through the marketplace. That's why early retirees have an advantage. When you're working a W-2 job, your income is largely decided for you, but when you've retired early, you often have more control. You can choose what account to pull from. You can choose when to realize capital gains. You can choose how much to convert to Roth or whether you do a Roth conversion at all. You can choose whether to use some of your cash runway to fund some retirement spending. And if you understand how those choices affect MAGI, you can sometimes save thousands a year on health insurance. Now, before I give you the 10 levers, I want you to understand what changed in 2026. The ACA premium tax credit or subsidies still exist, but what's changed is the temporary enhanced subsidies that have expired. That extra help that started in 2021 and ran through the end of 2025. And those enhancements mattered for two big reasons. First, they made subsidies more generous for a lot of middle-income households. And second, and this is the big one, they effectively eliminated the 400% of federal poverty level cliff based upon your household MAGI. Under the enhanced rules, once you got to higher incomes, your premium for the benchmark plan was essentially capped as a percentage of income. So the subsidy didn't suddenly drop to zero at a hard cutoff. Now that those enhanced subsidies have expired, we're back to the old structure again, where subsidies are tied to your household MAGI as a percentage of the federal poverty level, or FPL, and the cliff at 400% of FPL becomes a real risk. meaning if your household MAGI creeps just over that line, you can lose the subsidy and see your premium jump dramatically. That's why MAGI control is even more important now. And to make this easy, I'll include a link in the description to the federal poverty level table by household size so you can quickly see where your household lands. Which brings us to the main event. Here are 10 levers that early retirees can use to control MAGI and potentially lower ACA premiums. And I'm going to keep these very practical. Lever number 1, know what counts as MAGI and what doesn't. Now this sounds basic, but it's where most people mess up. ACA uses MAGI, and while the full definition is tax code-ish, the practical takeaway is not all money you live on shows up as MAGI. For example, if you sell an investment in a taxable brokerage account to fund your expenses in early retirement, only the capital gain portion generally counts as income, not the entire amount you withdraw. By contrast, withdrawals from traditional IRAs, 401ks, and 403bs are generally fully taxable, so those dollars usually count fully towards MAGI. So step 1 is simply stop assuming spending equals income. And to help with this lever, to help you know how to calculate MAGI, I've got a free MAGI Excel template you can download that I'll put a link to in the description. You can use this to estimate your MAGI and can update it to keep track of your MAGI throughout the year. And before you use it, be sure to listen to this video titled ACA MAGI, How to Calculate and Manage It for Big Savings, that explains exactly how MAGI is calculated. I'll put a link to this video in the description as well on the end screen. Lever number 2, use an HSA to lower MAGI if eligible. If you're enrolled in an HSA eligible high deductible health plan, contributing to a health savings account or HSA can be a sneaky good MAGI lever. And here's what's new for 2026. If you're buying a marketplace plan, all bronze and catastrophic plans are now HSA eligible. So this lever is available to a lot more people than it used to be. And why is this so great? Because HSA contributions can reduce your taxable income, which generally reduces your MAGI, while also building a dedicated bucket for deductibles and medical bills. And HSAs are what I call triple tax advantage. They're tax deductible going in, tax-free growth, and tax-free withdrawals for qualified medical expenses. Also remember that HSAs are great for medical expenses, but generally can't be used to pay your ACA premiums. So think of it as an out-of-pocket cost tool, not a premium tool. Lever number 3, use cash as a MAGI buffer. If you have a cash runway, savings, a money market fund, CDs, you can use some of that to cover spending without forcing taxable income in a year where you're trying to keep your household MAGI under 400% of FPL to keep health insurance subsidies. But let me add an important note here. This is something you do when you're close to the line. When without pulling this lever, you might slip just over 400% of FPL and your premiums could skyrocket. Because you need your cash runway in retirement to protect you from sequence of returns risk. Meaning if the market takes a dive early in retirement, you're not forced to sell stocks at the worst possible time. So think of cash as a MAGI shock absorber, not a lifestyle plan. What's not smart is burning down your cash reserves year after year just to keep premiums low and then putting yourself in a position where you're exposed in the next market downturn. So the goal is balance. Use cash selectively to smooth out a high MAGI year while keeping your runway intact for when you really do need it. Lever number 4, use Roth strategically as a potential pressure relief valve. Normally, Roth is the last bucket you want to tap. It grows tax-free and qualified withdrawals are tax-free. So it's an incredibly valuable account to protect for later. But here's the early retirement twist. If pulling money from pre-tax accounts or realizing extra capital gains would push your household MAGI over 400% of FPL, using Roth selectively can keep you under the line and save you a lot in premiums. Quick clarity on what Roth money means. If you're under 59.5, you can typically access Roth contributions, your basis, tax-free and penalty-free. A fully qualified Roth withdrawal, including earnings that are tax-free, generally requires you to be 59.5 plus the 5-year rule. And the 5-year rule is simple. The clock starts with your first Roth IRA contribution counted in tax years, and after 5 years, Roth earnings can be tax-free if you're also age 59.5 or meet an exception. Here's a practical use case. If you need an extra few $1,000s for spending and another taxable move would push you over the cliff, consider filling that gap from Roth instead. Just be careful with this lever as Roth rules get nuanced fast. There are ordering rules, and if you're under age 59 and a half, Roth conversions can have their own 5-year clocks for penalty purposes. Qualified versus not really matters. Lever number 5, control capital gains on purpose. This is the lever most people underuse because when you sell in a taxable brokerage account to fund your living expenses in retirement, what usually flows into your ACA household MAGI isn't the whole amount you sold. It's the capital gain. So if you need $10,000 to fund spending, the question isn't just what do I sell, it's how much capital gain will this sale create? And the lower you keep your capital gains, the easier it is to keep your household MAGI under that 400% FPL line. In a taxable brokerage account, you can often control whether you realize no capital gains, some capital gains, or a lot of capital gains. And the difference between some and a lot can be the difference between affordable ACA and painful ACA. So the rule here is simple. Don't accidentally harvest capital gains. Harvest them intentionally. Here's the practical move. If you're selling investments to fund living expenses, consider selling shares with a higher cost basis first. Same spending money, but potentially less capital gain, which means lower MAGI, which means a better chance of staying below that 400% FPL cliff. And if you have multiple lots, sometimes called tax lots, this is why lot selection matters because you can choose the lot that creates the least gain for the amount of cash you need. Lever number 6, watch dividends and interest, the silent MAGI problem. This one surprises people. Dividends feel like free money and interest feels harmless, but both can push MAGI up quietly. If you have large dividend holdings throwing off income or a lot of taxable interest from bonds or cash products, that income can raise MAGI even if you didn't do anything. So the tactic is, if you're trying to keep MAGI under control, don't ignore this. Run the numbers. Lever number 7, Roth conversions. Powerful, but they can wreck you. Roth conversions can be one of the best long-term tax planning tools for early retirees, but they are also one of the fastest ways to blow up ACA affordability if you do them blindly, because conversions add to your household MAGI. So the move isn't don't do conversions, the move is do conversions with guardrails and timing. Here are 2 practical ways to think about it. Option A, convert during your ACA years, but cap it. Pick a target MAGI range to keep subsidies and convert up to that line but not past it. Option B, if you need big conversions, consider waiting until Medicare. Once you're on Medicare, you're no longer playing the ACA subsidy game, so you may have more freedom to convert without triggering that 400% FPL cliff. And there's a window after Medicare starts at 65 and before required minimum distributions kick in, or RMDs, often 8 to 10 years, depending on your required distribution age. But keep in mind, Medicare has its own version of income consequences, and it's called Income-Related Monthly Adjustment Amount, or IRMA. IRMA can raise your Medicare Part B and Part D premiums if your income is high enough, and it uses a 2-year look back. So the trade-off is usually this. During ACA years, extra conversion dollars can cost you a lot in premiums. During Medicare years, extra conversion dollars might increase taxes and may trigger IRMA, which is often a smaller hit than losing ACA subsidies, but it's still real money. So if you're doing conversions, the right mindset is convert intentionally in the right years with a clear target, not just convert as much as possible. Lever number 8, use the right withdrawal mix. Here's a simple framework many early retirees use, especially before Medicare. First, spend from cash equivalents when needed, like we talked about, very selectively to stay under your MAGI target. Second, use taxable brokerage in a capital gains aware way. Third, use Roth strategically, like we covered in lever 4. And fourth, use pre-tax accounts strategically, but understand every dollar adds to MAGI. Now, this order is not the one perfect order for everyone, but it's a useful starting point because it aligns with the main goal, keeping flexibility and keeping MAGI under control. Lever number 9 is update your marketplace application during the year. This is the lever most people don't know exists. If your income changes or you realize your estimate was off when you first enrolled, you can log in and update it. So if you're watching this and you're thinking, I already enrolled, it's too late, it's not. You can still manage this. The marketplace was built for real life where income changes. Lever number 10 is some quick bonus levers or quick hitters. If you're right on the edge of a subsidy line, these can help too, depending on your situation. Tax loss harvesting. Realized losses can offset realized capital gains, which can lower MAGI. Charitable strategy. Donating appreciated shares instead of cash can avoid realizing capital gains. Third, pre-tax retirement contributions if you still have earned income. Deductible contributions can lower MAGI. Perhaps you're not fully early retired and are earning some income. You could make pre-tax retirement contributions, or of course, you can use this as a strategy if you're not retired yet. Maybe you're self-employed and on an ACA plan. This is a way to both save for retirement and reduce your MAGI. Now, you don't need all of these levers, of course. These are just options to help you reduce your MAGI and reduce your ACA health insurance costs. You just need the right levers for you to pull, and that's how early retirees keep health insurance from becoming the thing that derails their whole plan. And this is how people are pulling this off and retiring early and controlling their health insurance costs. They are doing it by understanding the rules and using the right levers. So here's my question for you. Are you planning to use the ACA before Medicare? And if you're already on an ACA plan, did you know you could update your income estimate during the year? Leave a comment regarding, and take a moment to download my free early retirement checklist. It's called the 12 Must-Do Steps to Retire Sooner and Smarter. It offers a quick practical guide to retiring early. You'll find a link to it in the description. And when you're on the go, check out my Early Retirement Roadmap podcast, available wherever you get your podcasts, and go to mikeupland.com for all of my media and resources in one place. Thanks so much for watching, and until next time, take care and make the most of today.